Welcome everybody to Volatility Trading Strategies. So in a previous daily blog, I highlighted all of our losing Iron Condor option trades for the past 2 years. And there's only been 3 of them, but they all lost money for different reasons. So I thought it was a good opportunity to show people what market environments tend to stop out short Iron Condors. So these are the losing trades in the last 2 years. And essentially it comes down to markets making a large price move during the life of our trade, either significantly up or down. It can stop us out. You can see the first one on the left was because markets were significantly down, and then this recent one because markets were screaming higher. They both end up with the same result. But I would much rather be stopped out because markets crash downward. It'll definitely cause us to lose money, but the advantage there is that volatility will almost certainly be elevated in that situation. And it gives us a great opportunity to get into new trades right away and to start trying to recover those losses. But when you get stopped out because of a major price move upward, that's usually not the case. That will usually mean volatility is depressed, and it may not be possible to get into a new trade right away. So that's where we are now. We had a great 14-month run of profit, but we did get stopped out last month, and unfortunately in this case, it was because the markets made a major move upward. So we can't get into any new short Iron Condor trades until volatility returns to these markets. Our VTS Iron Condor strategy does keep things pretty simple. We only sell short Iron Condors. But that doesn't mean that option traders who do have a full toolbox at their disposal have to just sit on their hands and do nothing. So today I thought I'd go over a few potential trades just for people who want to learn a little bit and get some more option trading experience. But 2 things to note. First, one of the things that's always bothered me when I see articles where people are introducing potential option trading ideas or giving people bonus trades, they never actually go back and show people how those trades did. Anybody can open a bunch of option trades, but it's fairly meaningless if we don't also go back and review them. So we'll open a few trades today, and then when the time comes to actually close them, I'll do another follow-up video. And maybe they'll make a profit, maybe they won't, but regardless of what happens, we will talk about the reasons why. And secondly, the best place to take these trades is in a paper trading account. They will be decent setups, but they're not actually full-on trade recommendations. So unless you're a very experienced trader, in that case, maybe you would want to keep the allocation very small, maybe trade 1 contract or something like that. But for the vast majority of people, I would definitely recommend paper trading only, just to follow along and learn a little bit. So let's get into those trades. So what we're looking at here is a 5-year chart of the RVX. This is essentially the VIX index for the Russell 2000. And you can see this most recent move has pushed volatility on the rut to historically low levels. Far too low to be entering any short volatility trades. This is just one of those rules that experienced option traders abide. You don't short volatility during low volatility periods. It can definitely work out in the short run if you get lucky, and maybe for 5 or 6 months if volatility stays persistently low and smashes all records like it has in 2017, but it's not a long-term winning strategy. So in my opinion, there's only 2 choices right now. Either do nothing, which is what our VTS Iron Condor strategy is going to do, or try to find some long volatility trades that make sense. And this is harder than it sounds because timing volatility spikes is a futile endeavor. When you're long volatility, you're what's called theta negative. Now, theta is one of the Greek symbols that represents your expected profit in relation to the passage of time. Theta negative means, all other things being equal, you'll be losing money every day that volatility doesn't rise. So obviously this is not an advantageous position to be in. If you buy a stock for $100 and next week it's still $100, you haven't lost anything. But when you're theta negative, either through options or volatility trading, if the markets are similar next week as they are today, you will have likely lost money. So this is why we have to be extremely careful whenever we're looking for long volatility trades. But as I showed, volatility on the Russell 2000 right now is at the lowest levels in at least 10 years. So it does make some sense here. But the question is, how do we do it? Buying the VXX or any of the other long volatility products is a terrible choice, because the accumulated losses while you're waiting for volatility to rise could be catastrophic. So we definitely have to be smarter than that. Now, option trading does allow us to customize our trade and define our risk. So we're going to go over 4 ways to potentially represent a strategic long volatility position. So I'm going to jump into the Thinkorswim platform and show you what those look like. So here we are again looking at the 5-year chart of the Russell 2000 Volatility Index, the RVX. This is essentially the VIX for the Russell 2000. And with today's reading down at 1450, you can see there's been very few periods of volatility this low. And last week, there was a couple of days there with values we've never seen. So certainly if this long volatility trade is ever going to make any sense, right now would be the time. So we just have to find a few trades that, if we're right, and our prediction that on a balance of probabilities, we should see a volatility rise in the coming weeks, we have to find a few trades that will capitalize on that assumption. So we'll go over to the option string and see if we can find a few. Now, one of the most important aspects of option trading is trade selection. It is the entries. And choosing the right time frame is one of the bigger aspects of that. So, for example, if we go too short and we go to the October 10 days, 10 days isn't really enough time for us to actually be right. And if we stretch it out to, say, 101 or 157, that's going to leave us exposed to the market a lot longer than we'd like to be, because at that far out in time, things tend to move a lot slower. So there is no hard and fast rule. Everybody's going to have their own style. But for me personally, I tend to stick to about 45 to 75 days to expiry. And certainly if you're going on the long side, you want to be on the high end of that. So this December 66 actually makes a lot of sense right now. Give us 66 days to feel out this long volatility trade and see if we can actually be successful. So we're going to select that one. Now, with markets at all-time highs right now, the Russell 2000 is, the S&P 500 is, pretty much all equities out there are knocking on the door of all-time highs. So the one trade that people are probably thinking right now in their head is just a long put option on the Russell 2000, trying to capitalize on a reversal of some kind. And you'll see in a minute why I don't like this trade at all, but we're going to just use that as a quick benchmark here to get things started. So right now the price is 15.10. We're going to do an at-the-money put option. It's going to look like this. Now, I don't want this video to be too long, so I am going to be talking about some Greek symbols here, and it may sound a little bit technical. Hopefully, I'm just going to go through a general overview here, but if you really do want to know more about the Greeks, about Theta and Vega and Delta, all the things that I'm going to talk about, I do have a full dedicated article on my website. I believe it's called Option Trading 101 Part 6, the one about the option Greeks. And you can get a more extended explanation there. But for today, I'm going to go over these things quite quickly and just look at the broad strokes of these trades. So the first thing I'm going to do is just quickly adjust this trade for how much money we have on the line. I'm going to try to make it around $10,000. So you can see over here the turquoise number. When I hover over our trade, we have $10,770 at risk for this trade. It is a limited loss. We can't lose any more than that. But for today's trades, we'll try to keep it around $10,000. Now, whenever we're trading the long side of volatility, we want to get what's called long Vega. If I hover over this hash line, which is today's price, you can see that what long Vega means here is that if volatility rises by 1%, all other things being held constant, our trade should profit $772. Now, that all other things being held equal part is important because as your Vega changes, of course, the other Greeks are as well, your Delta, Gamma, they're all going to be changing as well. But all things being held equal, long Vega means that if volatility rises, we're going to be making money. And that's what we're trying to achieve with this trade. So you might be thinking, well, great, long put it is. We're just going to do this, and hopefully the price goes down. But that is the problem. There's another Greek symbol called delta, which measures the directional exposure of an option. And you can see in this case, our delta is minus $143. This means that we actually have to be right both on the direction of volatility as well as the price direction of the underlying. And that's just adding too many layers of uncertainty. So again, no hard and fast rules here. Everybody can sort of feel out their own style. But for me personally, I believe that long puts and long calls are a complete non-starter for every situation. I suppose if it's part of a broader trade, if you hold the underlying stock or if you're trying to hedge of some kind, they're fine for that. But as a standalone trade, I just don't think that they make any sense. So we're going to lock in this price. I can't execute these. This is not market hours right now. But we're just going to lock in that price and use it as sort of a benchmark. So again, none of these are trade recommendations. But if they were, this would certainly be at the very bottom of the list. A long put option right now, this is just pure speculation and a very low probability trade. But we can tweak this trade just a little bit and actually improve it substantially. So what we're going to do instead of just a long put is the same thing at the money. We're going to buy what's called a long straddle. So we'll unclick this one and we'll take a look at what this long straddle is. Now again, we have to adjust for how much money we're putting up here. We don't want to put 71,000 on the line. So we're actually only going to do one contract of this straddle. That's risking $7,200. So the first thing we need to check, because we are trying to be long Vega, is we want to make sure that we are actually long Vega. So in this case, $515 to the positive. This is a good sign. And we also don't want to have too much delta exposure, like I talked about, directional exposure. And in this case, you can see the delta, at least on day one, is around 0. So this is a very good trade. And you might just be thinking, wow, that's great. We can profit in either direction because we're buying a long put and a long call. So it doesn't matter which way this goes as long as it moves. As well, we're long Vega, so if volatility rises, we're going to make money there as well. This seems like the perfect trade. However, of course, nothing is ever that beautiful. There is a strong negative aspect to this trade, and it's another Greek symbol called theta. This trade is substantially theta negative. Now, what theta means is the passage of one day is going to change the value of our contract by this much. So all things being held constant, if everything is the same tomorrow as it is today, we're actually going to lose $53. Not hard to see why this is a bad situation to be in. Nobody would ever buy a stock that has a minus 1% daily dividend. That's massive negative compounding that we're really trying to avoid. So essentially what we're doing when we're taking this trade is we're weighing the negative aspects of being theta negative, substantially theta negative, with the potentially positive aspect of being Vega positive. All the while making sure that we are not directional. So you can see this pink daily profit line, we're not directional. So this is actually a good trade to represent our opinion that volatility will rise. It's not without its downside. We are going to be losing money every single day that we're wrong here. But this is a pretty good option. So again, we're going to lock in this trade and we're going to check in on it later. A third trade that we could consider, because we do have the VTS Iron Condor strategy that only takes short Iron Condors, we might want to see what happens if we actually do a long Iron Condor. So we'll unclick that one and we'll actually go find, same thing. We're going to buy an Iron Condor in this case. See what that looks like. Now, this is a little bit too narrow. This is basically not a whole lot different than the previous trade. We're going to want to make it an Iron Condor. So I'm going to go through this very quickly. Basically, if we looked for probability of expiring in the money, we're going to look at about 16%-ish. This 17 is actually just fine. So the 1400 strike, as well on the other side, look for the, right about there, I guess, the 1590. So I'm just going to input those prices for you. 1590 on the long side. Of course, it's an Iron Condor, so we're going to do a short 1610, and then a long 1400. And again, we're going to need the short 1380. So this is what our Iron Condor looks like. We have to adjust for the dollar value exposed, so we're going to have to double this, get around 10,000. Actually, I'm going to make it the same as this straddle we did at around 7,200. So we can just drop that down. 7,275. So same value trade as the straddle above it. So this is a good comparison. Now again, we want to make sure that we're Vega positive. And we are. We're actually $918 Vega positive. So this is much stronger Vega positive than the straddle was beforehand. And again, we might be tempted to say, wow, that's great. We're even more exposed to long volatility. But there's always a flip side. And that flip side is the theta. We're going to be theta negative, but in this case, we're $89 theta negative. Remember, in the straddle before, we were actually only $54 theta negative. So essentially what this means is we're looking at a trade-off here. We're looking at the positive effects of being long Vega and the negative effect of that theta that's going to be robbing us of our profit every single day. And in this case, you know, in the beginning, it's going to be $89 a day. That is a huge negative compounding. So we have to be aware of that. So on balance, on probabilities, both of these trades are about the same. I mean, they have advantages and disadvantages. So you've got a long straddle that looks like this. It's both long Vega, short theta. And then you've got the Iron Condor that is quite similar. It's just the exposure is a little bit different. So which one should we choose? Again, no hard and fast rules here, but I am a conservative trader. I'm always conservative. So my basic fundamental belief with option trading is that most of the time, as long as we're being careful for trade selection and we're being intelligent about the strategies that we design, actually profit is fairly inherent in these trades. You're going to have a lot of winners. So I focus 100% of my effort on making sure that we reduce the number of losers and we reduce the exposure to those losers. We don't want them to be moving too quickly against us. To me, the same thing applies for volatility products. I've been trading them for 6 years, and there's plenty of times where we make massive profits in very short periods of time. I think that's inherent to the products themselves. So again, I spend 100% of my time focusing on when not to trade, when to be in cash, when to take the opposite side of the trade, when to just say right now is not the ideal environment. You can't swing at every pitch. If you do, you're going to have huge wins, but you're also going to have huge losses. So with option trading, volatility trading, and all of that, I tend to focus 100% of my effort on risk management. So it shouldn't come as a surprise that I'm actually going to select the Straddle as the better trade. It has less Vega exposure, but it also has less Theta exposure, which is what I'm looking for. I don't want to be killed every single day that I'm wrong on this trade. So again, this should be for paper trading only. These are not trade recommendations. I'm not telling anybody to go out and buy this. But if I had to choose between these 3 trades, obviously the long put is a no-go right from the start. The Iron Condor is good, but I feel like the Straddle is the right trade here. So we're going to lock in all 3 of these, and we're going to have something to come back to in a few weeks. Now, I don't want to take up too much of your time here, but we do have a lot of very experienced option traders in our community, and I get a lot of great conversations with people and a lot of fantastic follow-up questions. And I think one of them that I'm anticipating today is, what about a long put calendar? What about a time spread? So whoever's wondering this, that's a fantastic question, and it's definitely, in my opinion, an even better trade than these ones. But the problem with the calendar in today's video is that it's actually a Theta positive trade. It is Vega positive, so it is capitalizing on a rise in volatility, but it's a completely different trade. It's a totally different animal. It's actually very similar to a short Iron Condor, except it's long Vega. And I love calendars. I trade them all the time. But I definitely prefer to keep that into a dedicated video because it is an entirely different structure to this one. But yes, just sort of getting ahead of the questions that are going to come in, put calendars are also fantastic for low volatility environments. But we've got 3 trades down here, so we've got something to come back to in a few weeks. Hopefully these trades can actually play out as planned, but if they don't, there's always things that we can learn in failure. Thanks for watching. So go ahead and click the link right here, sign up for the VTS newsletter, and when you do, you're going to get full access to all of my trading strategies for a full month absolutely free. And if you are new here, please consider subscribing to my channel. Also, if you have any questions or comments, I'd love to hear from you. So go ahead and leave those in the comment section below. See you next time.